Good day, everyone. Our report is all about working capital management and financial planning and forecasting. But first, let us talk about working capital management. Working capital management. Working capital management is essentially an accounting strategy with a focus on the maintenance of a sufficient balance between a company's current assets and liabilities. Working capital management refers to the set of activities performed by a company to make sure it got enough resources for day-to-day operating expenses while keeping resources invested in a productive way. An effective working capital management system helps business not only cover their financial obligation but also boost their earnings. The term working capital management primarily refers to the efforts of the management towards effective management of current assets and current liabilities. Current assets investment policies. There are three alternatives policies. First is relaxed investment policy. Relatively large amount of cash, marketable securities and inventories are carried and a liberal credit policy result in a high level of receivables. Relaxed policy is just the opposite of restricted policy. In this policy, the estimation of current assets for achieving the targeted revenue is prepared after careful consideration of uncertain events such as seasonal fluctuation, sudden change in the level of activities or sales. Because of its conservative nature, this policy is also called conservative working capital policy. Second is restricted investment policy. Holdings of cash, marketable securities, inventories, and receivables are constrained. In restricted policy, the estimation of current assets for achieving targeted revenue is done very aggressively without considering for any contingency and provision for any unforeseen event. After deciding these policies are forcefully implemented the organization without tolerating any deviation. That is why it is also called as aggressive working capital policy. The last is moderate investment policy, an investment policy that is between the relaxed and restricted policies. Moderate policy is a balance between the two policies, restricted and relaxed. It assumes characteristics of both the policies. To strike a balance, moderate policy assumes risk which is lower than restricted and the higher conservative. In a profitable front also it between the two.
For current assets financing policies, we have permanent current assets and temporary current assets. Permanent current assets are the most asset needed at the low point of the business cycle. So, a permanent current asset is the minimum amount of current assets a company needs to continue operations. Inventory, cash, and accounts receivable fall under the category of current assets. Permanent current assets can be described as assets that are supposed to be maintained by the business over the course of time in order to ensure that the company is able to run its operations. These assets are considered to be current assets that tend to stay persistent on the balance sheet of the company over the course of time. However, temporary current assets are defined as sales increased during an upswing. Current assets are increased and these extra current assets. Temporary current assets are the current asset that fluctuates over time, season, and expected to consume or sell within a year. The decrease in these current assets will not impact business operations. They may change due to business activities. In addition, temporary assets can be defined as any current asset that is not pivotal for the company's existence, and therefore, having those assets are good, but it is not entirely essential for the survival of the company. Cash budget is an estimation of the cash flows of a business over a specific period of time. This could be for a weekly, monthly, quarterly, or annual budget. This budget is used to assess whether the entity has sufficient cash to continue operating over the given time frame. So, when we say cash budget, it is a budget prepared to estimate the cash inflows and outflows during a specific period of time. In other words, cash budget shows the cash inflows and cash outflows expected to occur in the immediate future period. It also provides a company insight into its cash needs and any surplus and helps to determine an efficient allocation of cash.
Now, let's talk about cash and marketable securities. But first, let's first define cash So cash, it is a reported on a balance sheet, generally includes short-term securities, which are also called as cash equivalents. So from an accounting perspective, cash is the most liquid asset as company can possess, or cash includes more than just the physical traditional bills and coins. Cash can include any other currencies as well as undeposited checks and amounts in a current account. Cash equivalents. So these are the short-term investments, the securities with assets. They have a high credit rating and are extremely liquid. So it is the cash equivalent. It is a investment that can readily be converted into a cash. So the investment must be short-term, usually with a maximum investment duration of 3 months or less.
Market security. Marketable securities are liquid financial instruments that can be quickly converted into cash at a reasonable price. So, marketable securities are unrestricted short-term financial instruments that are issued either for equity securities or for debt securities of publicly listed company. Also, there are two types of marketable security. First is marketable debt securities. These are government and corporate bonds, so one can trade these on the public exchange and their market price is also readily available. In the balance sheet, all marketable debt securities are shown as current at the cost until a company realizes a gain or loss on the sale of debt instrument. However, marketable equity securities, these are common and most preferred stock as well. So one can also easily trade them on the public exchanges and their market price information is easily available. All marketable equity securities are shown in the balance sheet at either cost or market, whichever is lower.
Now let's proceed to demand deposit. So demand deposit deals about the money deposited into a bank account with funds that can be withdrawn on demand at any time. The depositor will typically use demand deposit funds to pay for everyday expenses. In other words, demand deposit is money that you deposit into a bank account from which you can withdraw on demand at any time without any advance notice to the bank. Common examples of accounts that are often demand deposit accounts include many checking and savings accounts. Demand deposit has three different types. First is the checking account that is one of the most common types of demand deposits. It offers the greatest liquidity, allowing cash to be withdrawn at any time. So, checking accounts allows easy access to cash by withdrawing it anytime from ATMs, bank teller, debit cards, and by writing checks provided by the bank. Also, checking accounts do not pay any interest in most of the banks due to their pure on-demand nature. Second is the savings account that is for demand deposits that holds at a slightly longer duration compared to the short-term use of the checking account. They offer lesser liquidity and more interest rates as compared to a checking account. The drawback is that they do not offer any check writing facility, but a user can withdraw funds through bank tellers and through online banking. Lastly is the money market account. Money market demand is for demand deposits that follow market interest rates. Market interest rates are impacted by the central bank's responses to economic activity. So, money market accounts is the account which receives all the interest from the instruments in the money market according to the agreed upon terms. This account is separate from that of securities account and it only accounts for the proceeds and read more and purely based upon market interest rates based upon macro variable factors as determined by the central bank of a country. As interest rates fluctuate on daily basis, it becomes very unpredictable as sometimes it offers more than interest savings accounts and sometimes lesser.
At this point, let's define credit policy. So, credit policy is a set of guidelines that sets credit and payments terms for customers and establishes a clear course of action for late payments. Credit policy is the set of principles on the basis of which it determines who it will lend money to or gives credit who has the ability to pay for goods or services at a later date.
In simple terms, the credit policy of financial institution or business is a set of guidelines that highlight the following points, such as the terms and conditions for supplying the goods on credit, customer credit worthiness, collecting procedure and precautionary steps in case of customer default. Credit policy consists of three variables. These are credit period, credit standards, and collection policy. Credit period is the length of time buyers are given to pay for their purchases. In other words, credit period refers to the duration of time that is given by the seller to the customers to pay off the amount of the product that the customer has purchased from the seller. The credit period refers to the length of time allowed customers to pay for their purchases. It generally varies from 15 days to 60 days. When a firm does not extend any credit, the credit period would obviously be zero. Credit standard refers to the required financial strength of acceptable credit customers. It refers to the minimum financial strength of acceptable credit customers and the amount of credit available to different customers. A firm has a wide range of choices in this respect. However, collection policy refers to the procedures used to collect past due accounts, including the toughness or laxity used in process. It is measured by its toughness or laxity in following up on slow-paying accounts. A rigorous collection program tends to decrease sales, shorten the average collection period, reduce bad debts percentage, and increase the collection of expense.
Now, let's discuss what is account payable. Account payable is also called as trade credit and is the largest single category of short-term debt, representing about 40% of the average corporation current liabilities. So, accounts payable is the amount owed for the purchase of goods and services at a specific date. It is the money that a company owes to vendors for products and services purchased on credit extended in the normal course of business.
For our next topic, we have financial planning and forecasting. So, financial planning is the task of determining how a business will afford to achieve its strategic goals and objectives. Financial plan describes each of the activities, resources, equipment, and materials that are needed to achieve these objectives, as well as the time frames involved. So, when we say financial planning, it is a process of formulation of goals, policies, procedures, programs, and budget that refer to organization's finance function. It is the process of framing financial policies in relation to procurement, investment, and administration of funds of an enterprise.
In terms of forecasting, it refers to the tools and techniques used to predict developments in business, such as sales, expenditures, and profits. The purpose of business forecasting is to develop better strategies based on these informed predictions. Forecasting is a technique that uses historical data as inputs to make informed estimates that are predictive in determining the direction of future trends. Businesses utilize forecasting to determine how to allocate their budgets or plan for anticipated expenses for an upcoming period of time. Forecasting has different strategic planning to successfully do it, and these are mission statement, that is a condensed version of firm's strategic plan. Corporate scope, that defines a firm's lines if business and geographic areas of operation. Statement of corporate objectives, that set forth specific goals to guide management. Corporate strategies is broad approaches developed for achieving firm's goals. Operating plan provides management detailed implementation guidance based on the corporate strategy to help meet the corporate objective. Financial plan, it is the document that includes assumptions, projected financial statements, and projected ratios and ties. The entire planning process together.
Sales forecasting is the process of estimating future revenue by predicting the amount of product or services a sales unit, which can be an individual salesperson, a sales team, or a company, will sell in the next week, month, quarter, or year. Sales forecasting is the projection of customer demand for the goods and services over a period of time. In other words, it is the process that involves the estimation of sales in a physical unit that a company expects within a planned period.